Good morning, everyone. I want to thank you for joining our webinar on implementing the new lease accounting standard today. So we started this series last year and went end-to-end on adoption. And based on what we've seen, we decided that we needed to restart this in the new year here, subsequent to the 21 audit season, and really go end-to-end again to run through it. And you will see that the chat function is disabled, but the Q&A function is working. So if you have questions, please put those into the Q&A, and we will try to get to those during the presentation. If we don't, we will be following up with you directly after this. And this is being recorded, and the slides and the link to the recording are going to be sent out hopefully later today or first thing tomorrow. As you can see on this slide, I'm joined by my partner, Kevin Shives, today. And then I've also got Joe Burnell from our audit department on the call with us today. We'll be trying to respond to the questions in the Q&A and also presenting for the next 45 minutes or so. And then we're very fortunate to have Jess Vento with us from our software partner, LeaseCrunch. She's going to be doing a demonstration of the software a little bit later in the presentation, and I think you guys will really like that. Okay, just a quick commercial here about SSF for some of you that may not know about us. We are a full service accounting, consulting, and advisory firm. We used to have offices located in certain cities in Northern California, but I think we now have a couple of hundred offices spread throughout the US as we've gone mostly remote at this point in time. So the great news is we're in many different time zones at this point. In addition to audit and tax, our consulting group does a wide variety of services, including, fractional CFOs and controllers, outsourced accounting, internal audit, and a whole host of technology solutions. And one of the things I'm really proud about is we were one of the very first accounting firms that got their B Corp certification. And that's a designation that indicates that we strive to balance purpose and profits. And that's really important, I think, to our culture. If that's something that you're interested in or you'd like to find out more information, please reach out. We would love to talk to you about that. And you will also notice on the SSF website now that we've got the Sensiba Sensiba Center for Sustainability. Boy, there's a tongue twister. So please, if you're interested, take a look at that and reach out to us. And we'd be happy to talk to you about that.
And specific to SSF Consulting, as Frank mentioned, we provide outsourced accounting, internal audit, and SOX solutions, and also have a technology practice where we work with the software publishers that you see in the bottom right-hand corner of the slide. Accounting for leases being the focus today, we will provide a brief demo of LeaseCrunch toward the end of today's webinar.
Thanks, Kevin. So here's our agenda. We're going to cover ASC 842 from the lessee perspective on this call. If you participated in these webinars last year, a lot of what we're going to cover may sound familiar, but as we've learned over the past 6 to 12 months, you have to see it and you have to hear it multiple times before it really sinks in. So we've made some updates to the presentation for items that we're learning from the implementations that we've completed, which have ranged from a handful of leases on the low end to well over 100 on the upper end. And those certainly have all varying degrees of complexity to them. So I think we've got a real good experienced team right now that has seen quite a bit. So specifically today, we're going to go through some key definitions and background information. We're going to cover the adoption requirements. We're going to discuss what we're calling our 6 steps to success and introduce you to our approach and how we can help you, and then demo the software that we've chosen. And really, we are big proponents of using a software solution here. We looked at this and tried to run some models in Excel. And once you see kind of some of the requirements, I think it'll become pretty evident why a software solution that will help you track and roll everything forward and manage some of the intricacies of the standard makes a lot of sense. So hang on tight with us here and let's get going.
Great, thanks, Frank. On the next couple of slides, I'm going to cover some key definitions that you should be aware of. Under ASC 842, we have two types of leases, as you can see on the slide, financing and operating. The criteria for a financing lease are spelled out on this slide for you. Now, these are slightly different from the past bright line tests under the old standard under ASC 840, which were a lease term greater than or equal to 75% of the useful life of the asset, and present value of minimum lease payments greater than or equal to 90% of the fair value of the leased property. A key point on the slide I want you to note is the commencement date is the date that an underlying asset is available for use, and that may be different than the actual lease term. A good example that you can think of is maybe some type of construction period allowance. Okay, moving along here, the lease term is an important concept as it takes some analysis to figure out. The reasonably certain threshold is used here, and that's a term you're going to hear throughout some of the other slides we're presenting today. So for example, think of a supermarket that signs a 5-year lease with 4 additional 5-year extension options. Then they proceed to incur substantial leasehold improvements to open that store. So it's unlikely that they will be in and out in maybe 5 or even 10 years. Their lease term may be 15 years or even longer. There are many factors to consider, including past practices. For discount rates, the FASB also made the interest rate decision a bit easier for private companies by introducing this risk-free rate as a viable option if elected. And you'll hear more about that later as well. Okay, here's some more terms that we'll see used throughout 842. Right of use asset, that's a new one. You're going to hear that a lot. And what it is, it's going to be that balance sheet asset that is new under the standard under 842. And that's going to be booked as of 1/1/2022. And that's going to be along with the corresponding lease liability for each lease. Initial direct costs are now being tracked and factored into that calculated ROU asset. And another thing that's really important is lease modifications, because these will trigger some remeasurement in the future. Think of the past 2 years that we've gone through. In some cases, there were significant modifications that required remeasurement of leases and perhaps even some impairments to the right of use asset.
One thing I forgot to mention at the outset is we will do a couple of polling questions. So if you are licensed in the state of California, you will get CPE credit for today's presentation. So we'll break about every 15 minutes for a polling question. In terms of effective dates, so this standard was originally effective for public companies back on January 1st of 2019, and then the FASB delayed it for private companies and not for profits. For those companies, it's now effective as of January 1st of 2022 if you're a calendar year-end company. And the overall goal of all of this is to get the operating leases on the balance sheet. So now that we've covered some of the terminology, here's a high-level overview of the actual requirements. So like RevRec, which we adopted a couple of years ago, you can expect there's going to be a lot more disclosures in the financial statements related to this. You're going to have new policies, a discussion of the major assumptions and the practical expedients that will be employed, among the other required disclosures. And as it relates to practical expedients, there's several of them. But perhaps the most basic of these is whether or not to include the other lease costs in the lease payment. So let me explain that a little bit. Think of a triple net lease, which many of our clients have. So you've got CAM charges, do you include those in the base rent amount? And that's usually, taxes and common area maintenance and insurance. And so the trick there is you only include them if they're fixed. And this is a policy election that needs to be adopted and disclosed. And if they're not fixed, then they're considered to be a variable payment, and they don't go into the calculation of the lease liability or the right to use asset. But here's the kicker on that, and why a software solution like LeaseCrunch is going to help you. Those costs actually need to be tracked and disclosed at the end of the year when you publish your financial statements. And so, like I said, pay attention during the demonstration when Jess goes through that, because you're going to need to compile all of that information. And if you're scrambling at the last minute, odds are you're going to miss something. And then finally on this slide, companies are also going to have to choose how to adopt the new standard. And I've seen reports that show that this is still really a mixed bag on whether or not companies will use the effective date approach or the comparative approach. And Joe's going to talk about that a little bit later in the presentation. So as we've mentioned before, new standards are always challenging for companies to adopt. And if you don't have a plan pulled together to adopt, this or any standard, you're going to miss critical items along the way. Kevin, can you share your thoughts on the process that we believe should be used here and what some of the issues could be if a company makes mistakes early on in the process when trying to implement?
You bet. Accounting for leases under 842 is definitely a multi-step process. First of all, you got to collect all the leases and relevant contracts within your organization. And depending on the size and scope of your company, this may include many people outside your accounting department, such as in legal, operations, etc. And once you know the players, then you still have to go around and collect all the relevant leases and contracts. And the contract distinction here is that, you may have arrangements that weren't originally set up as leases, but may contain an embedded lease component under the new standard. I wouldn't underestimate how difficult it can be to locate your leases, amendments, and other contracts that may be impacted. Once you have that total population, you're going to want to review it all, identify the key terms. You've got to select your policy and any practical expedients, figure out your discount rate, and consider the impact of the variable components, and use all of this to make the necessary related calculations for your JE and ultimately your footnote disclosures. And of course, this isn't a calculate, book, and forget kind of deal. There will be maintenance, lease and contract modifications, terminations, and variable lease terms that will need to be tracked all along the way as they are paid, because that's relevant for your year-end footnote reporting.
Okay, so it seems pretty obvious to me if you make an error up front, this is something that will steamroll and kind of build on the back end, right? Because if you miss something early on, then as you go to make your calculations, you're going to have incomplete data. So really important to have a good plan there. And let's not forget about the concept of processes and controls. Changes are going to need to be made there as well to account for existing items and contracts and the ones that are entered into in the future. So you've really got to have a game plan in order to get this done right. And the interesting thing here is because we're talking about looking at a liability over a longer period of time, even with discounting that number back, an incomplete population can lead to a restatement down the road. So in addition to policies and procedures, you're also going to need to look at your chart of accounts, because you're going to need to add some additional accounts in there to help you implement that. So let's break right now and let's put up a polling question. Kaylin, if you could do that real quick, I'd appreciate it. Okay, so here's the first polling question. Where are you at, in terms of preparing for the new lease accounting standard? Already adopted, in process, have not started, and what is ASC 842? So we'll give you a second there to get that in there. We're at about 85 responses, get a couple more. Okay, we're going to end the polling there. Let me share the results real quick. So it looks like about 10% or so of the population has already adopted it. About a third of you are in process. A large number have not started, and we've got a small number of you that have the same sense of humor as me and are looking at what is ASC 842. So that's kind of what we expected to see at this point in time based on what we've seen so far through our own client base. Okay, let's keep going. Sorry, I've got to get back on my slide here. There we go. Sorry, I had to get back to do that. So, what we've seen so far is expected, a huge number of about 3 trillion in terms of lease liabilities with a corresponding right to use asset are going to get recorded through this entire process. So these are astronomical numbers that are going to hit the balance sheet of companies on a go forward basis. And lessees will be the ones that are most impacted by this. And there's 2 concepts on this particular slide that I think are of importance that you need to pay attention to. And these are a little bit tricky. So contracts that a company enters into will need to be examined to determine if they are a lease or contain an embedded lease. And I think this is really where companies are going to need the most support in the first year. So a physical asset has to actually be identified in the contract, and lessees will have to have the right to control the use of that asset. And control is defined as being able to take substantially all of the economic benefits of the asset through the lease term and also directing the use of the asset. So if both of those are not met, then you don't have control and the contract is not considered a lease. And also one other point that should be noted is a lessor can't substitute an asset under one of these contracts. So that's a mouthful and something that may require some consultation on. So we thought it would be helpful to discuss how to actually implement this and share with you our thoughts on a high-level 6-step project plan. And first and foremost, you need to be familiar with the standard. So you can read the entire document or you can search the web for a summary of the standard. As Kevin previously mentioned, depending on the size of your company, you may also need to figure out who needs to be on the implementation team. So some things to consider there: do you need to have legal representation? Do you need somebody from purchasing? Do you need somebody from finance? Obviously, yes, and perhaps somebody from operations. And then once you have that team in place, then you can start to work on actually coming up with the necessary information for the implementation team to review. So Joe, where would you start?
So Frank, to start, we have to determine our population. And this is fairly easy, with the actual leases. It's the other contracts that could be a challenge. So to start, I would just review my general ledger accounts, looking for things like recurring payments, perhaps even run some sort of vendor reports looking for recurring payments as well. Another reason to cast a wider net beyond known and identified leases, especially in some of these larger organizations, is there's going to be a lot of people throughout the organization that may be entering into contracts, and ultimately that implementation team is going to have to be comfortable and know that they have a complete population that they're working with on their implementation side. And another thing is document retention within a company. That could be an issue. Who's maintaining what where? If there's multiple departments with multiple people controlling some of these contracts, leases, etc., there's a chance that you might miss some of these when you start to implement.
And I think Jess is going to cover that as well when she goes through the demonstration in terms of the capabilities of LeaseCrunch to help you with that. Okay, so next up, you need to create a list of what you find. And really the goal here is to reduce the number of touches that you have to have on each one of these documents. And from our perspective, a best practice is to create what many refer to as a lease abstract. And if you're not familiar with that, that's really a summary of the key terms of the lease or the contract. So understanding the requirements of 842 and what data is going to be needed to run the various calculations is going to save you a lot of time down the road. And when we get into LeaseCrunch, once again, Jess will show us how you can store all of your documentation within the software itself. So that becomes a repository right there. Under 842, payment types are important as they are treated differently. Joe, what are the payment types and how are they treated?
Okay, so as you can see on the slide here, there's 2 payment types: fixed payments and variable payments. The fixed payments are the same each month and will factor into the calculation of both the lease liability and the ROU asset. For example, just think of your minimum monthly rent that is a known amount and predictable each month. Now, variable payments, on the other hand, are going to be different each month. Think of your CAM charges or maybe some kind of percentage of rent based on revenues. as these vary, they're actually not factored into that initial calculation of the lease liability or the right of use asset. Instead, they're treated as a period expense, but the kicker here is they need to be tracked for disclosure purposes in the end anyways. If you have a lot of these variable payments, this can kind of become an administrative burden, and it's a lot to deal with in some cases. So if you pay attention to this LeaseCrunch demo a little later on, there's going to be some information on how you can track and account for all those variable payments using the software.
Hey, Joe, I see a question in the Q&A right now talking about, is there any exception or alternative accounting method if the lease is between related entities? And we see that a lot in practice, right? Like a lot of our clients may own a building and they lease it into the operating company. I'm going to say the answer there is no.
Yeah, I know folks wish there were some exceptions, or hey, this isn't material, or hey, I've got the reason to not capitalize this, but there's really not much out there that you're going to get away with and say I don't have to capitalize this because of a related party relationship or something like that. So sorry to burst the bubble, but no exception for that, unfortunately.
Yeah, I think the only thing you may hang your hat on there is if it's 12 months or less, which I think we're going to cover in a couple of slides here.
Yep, exactly.
Okay, so on this slide, this is what I like to refer to as the items that are supposed to make my life easier. We've mentioned some of these already. For example, combining lease and non-lease payments will simplify the recording of the amounts. For private companies, you're going to be allowed to use the risk-free rate, so you don't have to go and figure out your incremental borrowing rate, which can be a bit of a challenge, and be an even bigger challenge if you're going through an audit, because the auditors will put a lot of scrutiny around that. There's also a practical expedient that allows you to exclude leases that are less than a year in length, which I just mentioned a second ago. And then finally, there are policy elections to apply discount rates to classes of assets. And the thing I want you to think about there would be, like if you're a big enough company where you've got a vehicle fleet or an equipment rental fleet, it's important to have somebody on the team that knows the nuances of the policy elections and the practical expedience, as this is going to save you a bunch of time in the long run. Okay, here's a few more. Some of these are certainly going to help during implementation. You don't have to go back with hindsight and reassess the lease classification that you made, or the initial direct costs for leases that were entered into before the standard was adopted. And so the interesting thing is, on the flip side, there may be some instances where you do want to apply hindsight for certain items, such as the concept of the lease term. Like Joe mentioned earlier, if you're that grocery store that has a long lease with 5-year lease terms on it, you may want to go back and reassess that as part of this process if you don't think you got it right the first time. And then also around the concept of purchase and termination options, you may apply some hindsight there, depending on your particular situation. And I see a couple of additional questions there. Just to clarify, there's no minimum threshold the company can set in order to not have to recognize the lease on the balance sheet. What I would tell you there, and Joe, back me up on this, is technically, they didn't set a materiality threshold to this. The one caveat there is the leases that are 12 months and under. That's a discussion if you're if you're a company that gets audited, that's probably a discussion to have with your auditors if there's an acceptable threshold, but in the standard, there is no minimum amount talked about.
Yeah. So just to piggyback on that, Frank, so maybe if you're a company that, owns the building you operate, and okay, you've got 2 copiers that you lease, and those are the only leases you have within the whole company, you might be able to get away with saying, you know what, these are so immaterial, we're not going to capitalize. But, beyond something that is incredibly, minute, like a couple copier leases or something like that, it's probably going to be hard to get away with not capitalizing those. And then one thing I want to mention back to that, the 12-month lease option, that's come up a lot with some clients I've worked on already, where they have a 12-month lease that they kind of have a handshake agreement to renew every year. So this is a kind of an area where some companies may try to fudge things a little bit and say, you know what, I've only got a 12-month lease, I'm not going to capitalize it, wink wink, I don't know if I'm going to renew next year. But that kind of goes back to this best practices idea, or reasonable assurance idea, basically saying, you're probably going to be in that building for a few more years. So you're not going to be able to get away with saying, hey, this is a 12-month lease, I don't have to capitalize. So just something to consider in the future as well.
Great. Joe, there's one other question in there that I think will be a layup for you. Let me give it to you. What is the risk-free rate?
So the risk-free rate, that is just the rate that the U.S. Treasury has out there on the market that will actually change daily. And what it is, it's a set standard rate. And the great thing is that LeaseCrunch actually has links to all of the daily rates depending on how long your lease is. So let's say you have a 3-year lease, you would use the 3-year U.S. Treasury rate as your discount rate. So there's no assumptions, there's no estimates. It's a known amount that you can rely on, and it really does make the adoption process a little more efficient on your end. Now, we do have many things to share with you in our future webinars, and we will dive deeper into some of the more detailed concepts of interest rates and what some of the various elections might result in a higher liability or a lower liability on your balance sheet, and some of the ramifications with some of those. So great question so far, though.
Great, thanks. So on this slide, what we're talking about is basically the proper classification between a finance and operating lease, which is critical to the adoption as well. In actuality, it's going to impact the timing of expense and geography within the income statement itself. So let me explain. With a finance lease, you're going to have 2 components to expense. You're going to have lease expense and interest expense. Under an operating lease, you're just going to have lease expense. So back to a financing lease, you're going to use the effective interest method. And for an operating lease, you're going to use straight line. So I think you can kind of see already, we've got some different ways of handling this. In a financing lease is really going to be similar to what we used to call a capital lease. The main difference there is the removal of the bright line tests. You should also note the introduction of the reasonably sure concept here. You have to have one of the items under a financing lease for it to be a financing lease. Otherwise, it's just an operating lease. Okay, it's about time for another polling question. So Kaylin, can you please pop one of those up? Okay, here we go. What topics have been the most challenging so far? And it's a single choice item here. If we can get some feedback on that, that would be great. This will help us with some future slides and future presentations. So our choices there: practical expedience, discount rates, identifying leases, something other, or none. And we'll give that a second. So it's looking like, about 40% or so are having some challenges with the practical expedience. About 15% or so are being challenged with the discount rates. Identifying leases, that's certainly about a third of you. That's where I expected to see most of the challenge myself. And then we've got some small percentages on other and none. Let me just pop those results up there real quick for you to see. So I think that's pretty consistent with what we've seen. Especially in the first year, I think the practical expedients are going to be a bit of a challenge. And once you get beyond that first year, I think things will settle down there. Okay, so let's keep going. So lastly, once you go through the entire process, you're going to have to determine how to actually adopt the new standard. Joe, what are 2 ways of adopting, and what do you see as a favorite there?
All right, so as you can see on the slide here, we've got either the effective date method or the comparative method. And some of us can get a little frustrated with a lot of the new guidance that comes down from the FASB, but they actually did us a small favor here by letting us use this effective date method. So that what that means is for a calendar year end company that will present comparative 2021 and 2022 financial statements together, this basically means that your 2021 financial statements will not change, and they'll still be shown under ASC 840, and then only 2022 needs to be presented under the new standard. And so remember, for everybody, hey, we're in 2022 now. This is the year that needs to be adopted and accounted for going forward. Now, Frank asked, what's my preference? It's definitely the effective date method because it doesn't require you to go back a whole nother year, do a whole nother extra year of accounting and adoption once you started. But on the flip side, if you're a new public company or maybe a private company with aspirations of becoming a public company in the future, you're probably going to want to consider using that comparative method, as you're going to need that down the road for some additional disclosure purposes for some of your public filing documents.
Great, thanks. So we've basically tried to simplify our approach and the services that we're going to offer so we can offer something different to companies, basically a soup to nuts type of approach. Some companies are going to need, help with all of this. Some are just going to need a little bit, and some may just need a software solution. So Kevin, can you walk us through the boxes here and focus on maybe what a total outsource may look like and how clients can take on portions of that project on their own?
Sure, Frank. We've set up our offering to provide clients the options across the services shown on this slide. We suspect that many companies, especially in year one, are going to want more help here. So for them, we can do a complete outsource effort for them. Others will have an implementation plan and the internal resources required to handle it. And so maybe in that situation, they just need a tool to help them with the calculations, the footnote, and to simplify the ongoing maintenance. We can provide that as well via the LeaseCrunch software. But, to help clients figure out where they are on this, it all starts with an assessment. This is where we'll go through and help clients figure out their preparedness for the standard and what level of service they need. We have a nice checklist and guide that makes this assessment effective and very efficient.
Yeah, and I think those with variable leases and potentially embedded leases may want some assistance early on in the process. The risks related to embedded leases, I think, in our practice are going to fall into a couple of different potential areas, and I'll cover those now. So, if you have an IT service contract, you may have an underlying dedicated server that's embedded in that contract. So, if you've got that, you need to do an evaluation of it. For our manufacturers, for our companies that have their product contract manufactured, do they take all of the output from a particular facility, or does that facility have a piece of equipment that's dedicated just to you? What I think of there is a lot of our food and beverage manufacturers that may have, a special packaging or a special process that needs to be done. If the co-packer maintains a piece of equipment that's used only for you, technically you're leasing that item, and so you're going to need to factor that into your overall evaluation. And then lastly, in our construction practice, do you have dedicated assets that are in service agreements? Those may need to be analyzed as well. Okay, so let's take a break from us talking, and I'm going to stop sharing my screen, and we are going to let Jess take over for a little bit and run through LeaseCrunch.
Thanks, Frank. Thanks for having us today. So already covered lots of things about leases. So let's talk about how some of the things that Joe, Kevin, and Frank have discussed already can be made a lot easier by using LeaseCrunch. So what we're looking at right now is our My Leases screen, and this really becomes your home base once you've added your leases. We're not going to spend a whole lot of time here today, but I want to spend some time talking about adding leases to LeaseCrunch. Joe talked about discount rates. We're going to lean into that a little bit. We talked about terms. So let's walk through real time and add a lease. It takes about 3 minutes. The first thing we're going to do is talk about our reporting entities. So some of you might have just one entity within your organization. Some of you might be managing multiple balance sheets. We can support whatever you have. We can also support currency. We didn't talk a lot about currency today. Some of you may be reporting in foreign currencies. The first thing I'll do is enter my lease name. We'll say that we're on Main Street today. We've got an opportunity to add things like description and terms. So lots of our users include things like a VIN or serial number here. We've got things like manufacturer. If there's some information that's important to your organization, we can include that here. We've also talked a little bit about asset types. So we're gonna include those asset types here. Depending on, you know, what different things you need to know about your leases, there's all sorts of information we can include here. We also have the opportunity to add locations and lessors for each of our leases. We know that for some of you, this is a very important part of adding your leases to a system, is to being able to track where that lease resides, or, you know, where that copier or vehicle, etc. And then also what the lessor looks like. And if you can track those, that makes it really easy. So let's go next to our lease term wizard. Here within LeaseCrunch, we've built a wizard that will help you walk through your early termination and renewal options. Within LeaseCrunch, we're going to add a lease. Let's say we've got a lease that begins on 5/1 and it's 36 months. Our end date of that lease is going to be 4/30 of 25. So LeaseCrunch is really built to whatever data you have, we're going to take it and we're going to get you what you need. Next up is going to be that early termination option. We talked just a smidge about reasonably certain. Are you reasonably certain to bypass that early termination? Remember that reasonably certain is a high bar. Some economic incentive goes into that. And then next up, we'll talk about our renewal. Are you reasonably certain to exercise a renewal? You know, if you have a 5-year lease and you're reasonably certain to stay in that 5-year lease for an extra 5 years, LeaseCrunch is going to help you walk through those decisions and also ask you for those new end dates. So when I finish my wizard, I'm going to see that I've got a start date, end date, and term, and we've also calculated our ROU asset life. That ROU asset life becomes very important when we're determining our lease asset calculations. And then finally, on this first screen of adding our lease, we'll have the opportunity to add comments and then custom fields. Lots of our users like our custom field functionality for that kind of extra stuff that's unique to their organization or their leases. Next up, we'll talk about our things like lease payments. We've talked a lot about lease payments and variable lease payments today. Joe spent some time talking about discount rate. So let's talk about that for a second. We've already discussed risk-free rates. Within LeaseCrunch, anytime you see a blue question mark, we're gonna click on that and open up our tooltips into a new tab. We're gonna take you exactly to the topic that you clicked on. We have written summary guidance. So those of us here at LeaseCrunch that have read through the standard, have pulled out some terms and hopefully made this language that's useful for all, not a little bit less technical, if you will. And within our summary guidance, we'll have a link to those risk-free rates. So like Frank was just talking about, we're going to link those risk-free rates here and be able to get exactly what rate that is. So if we apply this current month here, you know, we talked about if our lease starts today and it's 5 years, we've got our rate right here for us. So a really handy, easy tool, easy way to get, you know, those rates if you are choosing to use that risk-free rate. So back into LeaseCrunch, I'm going to enter my discount rate. We'll enter then our incentives received and initial direct costs. And then next up, we're going to enter our payments. So whatever information we happen to have here, we're going to enter that payment. You know, sometimes those payments change throughout the life of the lease. We'll update that as necessary. So these are going to be the things that Joe sort of talked about, you know, specifically related flat payments or already pre-written payments as related to that lease. We'll talk about those variable expenses in just a minute. Another thing we have here in LeaseCrunch is called our lease classification wizard. So we've talked a lot about finance leases and operating leases and about the classification of those. So our lease classification wizard is going to ask the 5 criteria questions related to classifying this lease as operating or finance. For those of you familiar with ASC 840, there were 4 criteria to help us classify the leases. Now we've got 5. We have those linked right here for us. So depending on how we answer these particular questions will help us determine exactly what the classification is for this lease. If I had a hunch, your auditors will be very pleased that you've got a great documentation tool here for classifying those leases. Next up, we'll have our opportunity to customize the GL accounts based on the classification that I've selected. So as a former accountant, I love this screen. My system remembers which type of lease classification I have and then pulls in our GL accounts associated with those particular classifications of leases. As we probably won't talk about here today, but in our administration setup, we fully customize our GL accounts to match your chart of accounts. And our administration setup just doesn't take long, maybe an hour or so. So what we're going to do here also is if you have things like cost center allocations, lots of our users are allocating expenses to maybe certain divisions. You know, if you have an office type lease and your sales and marketing teams are there and you're kind of budgeting those sales and marketing teams to have their expenses separate, we can support adding our cost center allocations here. And next up is going to be that variable expense and non-lease payments. So we talked about things like CAM, things like parking expense, things like maybe rent payments that change based on index. Lots of times lease, especially office leases, are written in such a way that the increase in rent is based on some sort of CPI escalation. We can come into LeaseCrunch, we can add that information here. Adding our payments in this particular part of the system is the same as we saw before. And then like Frank mentioned earlier, this information is going to be required on your footnote. So LeaseCrunch will pull all of this information in. Our fifth step within LeaseCrunch is attaching documents. So we talked briefly about document storage. As a former property management professional, I will tell you that property management type softwares, attaching documents was an afterthought. You know, property management software has been around forever and it was an afterthought. So those kind of attachments are buried deep in menus. Here in LeaseCrunch, that document storage is just right here as part of our workflow. So we can easily find the information that we need in order to add the particular lease file and any amendments, anything you need. We've got unlimited file storage. We also have an opportunity to use a review and approve function. So if you have users in your organization that are doing the data entry and then you want somebody else to just take a second look at that lease in order to get an approval, we've got a review and approval function that works really well as well. We can notify them that a lease has been entered. And when we submit for review, we're going to head back over to our My Leases screen. Like I said before, this really becomes home base. This is where you'll spend the bulk of your time once you have added your leases to LeaseCrunch. I know that reporting is very important to many of you. So let's spend a few minutes taking a look at what our reports are going to look like. I know that the footnote disclosure, amortization schedule, and journal entries are really important for many of us. So I'm going to select my leases here. And at the bottom of our first My Leases screen is where I'm going to run my reports. I'm going to take a look at an entire year of journal entries today, just for the sake of our example. You can also fully customize your journal entry columns. So if that's something that's beneficial to you so that you can import your journal entries into your financial system, you can drag and drop this information, and then your journal entry columns are going to print out in the format that you need. We'll give that just a second to load. And we'll see our journal entry. The journal entries are going to separate your leases by finance and operating. So I've selected multiple leases here. It's going to combine the lease and cumulatively or summarize your entry into finance and operating leases. For our first month of entry, we're always going to see the initial recording of our ROU asset and lease liability. And then we're going to see that an additional first month of expense, that first month entry. So we're going to see our amortization expense, our interest expense, our ROU asset, and our lease liabilities, and then our operating expenses to follow. Our criteria tab is going to include any particular criteria that we use to run this report. And our leases tab will show us everything about the leases included. So a really handy tool to know exactly what parameters were used when you ran the report. Next up, we'll take a look at our amortization schedule. Again, amortization schedule is going to export into Excel, and it's going to have 3 tabs. We'll be able to see kind of that horizontal view of our entries as well as our balances. We can use this report to tie out to our general ledger. So doing that monthly reconciliation in order to make sure that your reports are tying back to your outside systems. And then finally, we have our footnote. Our footnote is going to include all of the things that we kind of already discussed, but there's a lot to include here. So our footnote is going to include our lease expense information for the year. We're going to have a big section here that's new. This is going to include things like our ROU assets obtained in exchange for lease liabilities, weighted average remaining lease term, weighted average discount rate, and our maturity analysis, all separated by finance and operating leases.
Jess, before you move on from there, we need to hit one more polling question real quick. So,
Got it.
Kaylin, can you launch that, please? And while we're doing that, we're getting close to the end of the presentation here. So if you've got questions, please get them into the Q&A. So we'll be ready to go with some answers there. So the question we're asking now is, what is the likelihood you have contracts with embedded leases? And we just want to get a sense, you know, in terms of where companies are at relative to that.
You know, Frank, while you're talking about embedded leases, on our website, we have an embedded lease identifier. So for those of you who have these contracts that maybe are supplier contracts with a use of an asset, we have a free tool on our website that you can use to kind of figure out what you have. I know that we hear that question a lot. You know, how do I know? Maybe I don't know at all. So it's a great tool to kind of help you get started.
Yeah, a tool is definitely very helpful there. So it looks like, based on what we're seeing here, a small percentage of you are pretty oh, I should end the poll and share that. Let me do that right now. So a small percentage of you, about 10% or so, are sure you've got them. The lion's share of you are in that bucket of, you know, hey, there's a 25 to 50% chance we've got them, and about 25% of you said nope, we're confident that that no one has embedded leases here. Hey Jess, I may have missed it, but did you cover the concept of what's recorded on my books now versus where I need to get to? Because part of all of this is unwinding what may be there for deferred rent and things like that.
That's a really good question, Frank. I didn't today, but let's take a look at a lease that I've previously entered so we can take a look at that. As part of entering your leases into LeaseCrunch, here at LeaseCrunch, we call those transition leases. We were transitioning from 840 to 842. And when you're entering that lease, your start date in LeaseCrunch is going to match your initial application date. I've seen some questions about we're not quite sure what that date is, and that's totally okay. That's a really common question that we see. And then we're going to, on step 2, where we added our discount rate, our payments, and our classification, we're going to have a section that talks to us about those existing balances. So when we have balances on our balance sheet like deferred rent, capital lease asset liability, we're going to enter those balances here so that everything flows through our ROU asset as part of our initial journal entry when we're transitioning to the new standard.
Great. So thank you, Jess. That was fantastic. And that's a great overview. I know there's a lot to get to in a very short period of time. Let me reshare my screen so that we can wrap up here and get to the Q&A. Hopefully you can now see the recap. So the implementation date is coming pretty quickly here, you know, in terms of when you have to report. Obviously, we suggest getting out in front of it as much as you can. I think our 6-step plan and the other tools that we've assembled are really going to be able to help people adopt this. We have a landing page set up on our website that's got more information. That when you get the slides, you'll get the link there with it as well. And if you'd like to get on the phone and you know, have a consultation with us, we're happy to do that. So let's kick it over to, sorry, one more thing. Some things we're thinking about for future webinars, you know, lease modifications, sale leaseback accounting. We're going to talk about the practical expedience, some transition guidance, and then we may cover some lessor accounting on the back end. That's really not a big issue that we've seen for a lot of our clients. So if there's anything else you guys are interested in, please either chat it in today or, excuse me, put it in the Q&A today or reach out to us directly. We'd be happy to try and cover some additional topics. Okay, now on to questions, and we've got a bunch of them. So Jess, can you take this one? How long are the attachments stored in LeaseCrunch?
Yeah, that's great. So attachments are living in LeaseCrunch as long as you're a LeaseCrunch client. So we have unlimited storage here in the system, and we do recommend that you quote unquote archive your leases if they're expired and outside of your financial reporting period, but they'll live there forever. So if you ever need to go back and see those, you certainly can.
Okay, and then if they decide to leave LeaseCrunch, is there a mechanism for them to download or get something from LeaseCrunch that would have all their documentation?
Yep, we can certainly help with that.
Okay. And then there's another question. We'll hit the LeaseCrunch ones first. Do you enter initial cost as variable expense in LeaseCrunch?
That's a really good question. On step 2 of entering a lease, you're going to have initial a space for initial direct costs. I kind of glossed over it today, but that initial direct cost is something you'll certainly add when you're first entering your leases into LeaseCrunch. I will caveat that with, if it's a transition lease, we're going to enter that stuff under existing balances instead of that initial direct cost field. But our system will walk you through exactly what you need to get that entered.
Okay, great. Joe, what if you are a 6/30 fiscal year end company? I'm not good enough to do the math on the fly here, so can you answer that one, please?
That's a great question, because the FASB doesn't make it easy either. So I'll do a real quick overview. So the actual detail in the FASB standard states that any year that begins after December 15th, 2021, that is when you must adopt. So it's easy math for a calendar year end company. You start January 1st, 2022. That is after December 15th, 2021, when you're required to start adopting. So if you're a 6/30 year end, you get a little bit of a breather and you get a reprieve on your adoption for an extra year. So let's say your year end is June 30th, 2022. That would have meant that your start of your year was July 1st, 2021, and that falls before December 15th, 2021 start date. So without giving you too many more dates and ranges there, if you're a June 30, 2022 fiscal year end, you do not have to adopt for another year. Now, you can elect to early adopt if you so choose to, but you would not be required to yet. So when you hit your June 30, 2023 year end for your fiscal year ends and a lot of your nonprofits, that's when that's going to be officially required for you.
Yep, perfect. And then we had a question for operating leases. Do we need to record an asset and liability? If no, then what is the change from expensing rent on a straight line basis?
So I wish I could say if you only had operating leases, you didn't have to worry, but that's the biggest change for this new standard, is pulling all the operating leases onto the face of the balance sheet. So our historical footnotes, we just had that, nifty little disclosure. Here's my lease commitments for the next 5+ years. Now all those operating leases are joining the formerly known as capital leases, now known as financing leases, on the balance sheet.
Yep. Jess, in LeaseCrunch, there is some sort of procedural checklist there, right, to go through. I thought you guys had something embedded there.
We have a lot of help guidance throughout our application, and we also didn't really talk about this, but we do have a policy election checklist that will really help you kind of guide you through a lot of the elections we talked about here today.
Okay, Curtis, if we didn't catch what you needed there, just reach out to me after the webinar. And then someone's asking for samples of embedded contracts. I don't know that we have a list of those, Joe, but we did talk about some of the embedded ones that are more popular, at least from what we've seen in our client base. That's a tricky one to kind of put out. Here's everything, right?
I think the easiest concept to start with is a lot of kind of an IT service contract. You're going to have some embedded servers that are built into that contract. I think that's the most common case we see instances of embedded contracts. The other case we see is, let's say you're a manufacturer and you utilize a separate contract manufacturer to produce some of your raw materials or other finished goods. Let's say that you were the only customer that utilized that contract manufacturer, and they have some machines and tools that are being leased to prepare your raw materials or inventory. Technically, those would be leases that you as the manufacturer would have an embedded lease to account for. Now, that's probably not a practical example of you being the only customer of a contract manufacturer, but that's the easiest way, just on a really high level, to kind of explain that concept briefly.
And then there's a question, arguments for or against considering corresponding finance lease assets as tangible or intangible. I'm not sure I understand exactly what they're asking for there, Joe. Any thoughts from you on that one?
That's a good question. I haven't really come into that much, to be honest. So we're going to say we'd love to get back to you on that one, since we haven't had that question before, but good one.
Yeah, and we may need a little bit more information relative to what the real question is there, and that's probably something, best handled via a call or an email exchange on that. What about relative to SaaS agreements? Do we see any impacts there? I think you kind of covered the basic one that we typically see, right? The IT service contract.
Mm-hmm. Yeah. That's the main one we're seeing out there. But there's always an exception to the norm, and there's always nuances to consider. So especially on the first year of adoption, taking that little bit more of a deep dive and taking the extra time to really assess your entire portfolio, what might be out there that might need to be considered as a potential lease as well. And it's good to start completely and fully from the beginning.
Yeah, there's a question, it says interested in year-end financial statement presentation and disclosures. I think we'll cover that in a future webinar, but my best advice there is I would go look at public company filings and read through those footnotes. Private companies will have a little bit scaled back, but you can get a flavor for the type of things you're going to need to disclose by looking at that. And then we got one more here. During COVID, many leases may have had partial payment holidays. Does that make the leases variable? And I think the answer there is going to be no, but you've got to factor in, that's one of the lease modifications. And so that's where, once again, the software will do much of the heavy lifting for you.
Yeah, so let me just piggyback on that, Frank. So let's pretend we're in the year of adoption. So we're in 2022, and that as of July 1st, 2022, there was some kind of rent holiday allowed or some kind of change to that original lease. That's when we kind of have to trigger that modification concept. And you would actually have to do a full reassessment of what the discount rate is as of that modification date, and adjusting some of the inputs as well. So if you're kind of doing this all in Excel on your own, and then you have these modifications and you think, okay, I have to redo all this and track it and monitor it and make sure I did it correctly, that's where you really get into a lot of challenges, among many other things here with adoption. So the great thing about LeaseCrunch is that would do it all for you, map it out, produce your entries, and really save some of the time and the burden of doing that on your own. So
yeah, no, that's terrific. I see we're out of questions at this point, so I want to thank everyone for joining. We will be reaching out with the slides and with the link to the presentation for you to have. As always, you can go to our YouTube page, the Sensiba Sanfilippo YouTube page, and see a whole host of videos out there, including our entire series on lease accounting from last year. Thanks for joining. We will send out an invite to our next presentation shortly. And yes, you will get your CPE certificate through email. Thanks, everybody, and have a good day.